Okay, let's get started. All right. So first of all, I want to make one clarification. So the second quiz is actually at week 11. Okay, not week 10. Okay. You can actually refer to if you look at our canvas, there are important dates. And these are the dates for both the quiz and assignments. All right. So this is one correction from last lecture notes. Okay. So last week we see how to price option by the binomial model, which we will create a replicating portfolio. All right. So one key thing we notice is that the price of an option has nothing to do with the real world probabilities. Okay? So when we create such a portfolio, we then derive the price of the option by saying that the price of the portfolio must equals to the price of the option at the beginning because they have the same payoff at maturity. All right? So today we're going to finish the binomial model, trinomial model. They are all the discrete models. And then we will start our journey in the continuous time stochastic process. Okay? So recall the binomial model. We will create a portfolio which consists alpha dollar in the money market account and beta shares of the underlying. And then we create such portfolio and listing two equations. One corresponding to the scenario where the underlying asset price goes up, and the other one corresponding to the scenario where the underlying price goes down. Okay? So I make sure the payoff of my replicating portfolio is the same as the option in both cases. And then we have a system of linear equation with two equations and two unknowns. And this system of linear equation has a unique solution where we can write alpha and beta. Okay? So basically consider alpha and beta as the unknown variables and all the other terms in the equation to be known. Okay? So we can always, which means under the assumption of the binomial model, we can always find a replicating portfolio, alpha and beta, such that the payoff of this portfolio is the same as my option. Okay? In this case, we say the binomial model market is, the market is complete, which means whatever the payoff of your option, okay? You see this one? This one is not option specific. It can be a call option, it can be a put option, it can be any option, all right? The payoff of any option. And for any payoff types, you can still get an alpha and beta. And it means for any derivative, you have a unique portfolio to replicate such an option, so the market is complete. Okay, we will see the definition of complete market later. Okay, so then by no arbitrage principle, we say the price at the beginning of the replicating portfolio must be the same as the option. And that's how we derive the price of the option. So the price of the option at the beginning is the same as the portfolio, which consists of alpha in my money market account and beta shares of my underlying asset. Okay? And then I substitute the alpha and beta from my previous solutions. Okay, I got my alpha and beta here. I put in to find my initial value, and you can simplify the terms and write it in this way. Okay, Okay, let's look at this. The first term, do you recall where is this? This is called the discounting factor. So last week we say you put some money in your bank account. Say if it's $1, later at time t, you will get out this amount, right? This is your principal plus interest, continuously compounded interest rate. So this is called capitalization factor. So, and this is a discounting factor. So capitalization factor is today I got $1, at maturity how much I get. Okay, that's your capitalization factor. And then if at maturity I got $1, today I got e to the power of minus RT. So that's my discounting factor. So discounting is from maturity to today, and capitalization is from today to maturity. All right? So the first term is a discounting factor. And these two terms are the payoff of the option under the two scenarios of the binomial trade model. The binomial model says my underlying will either go up or go down, right? Only two scenarios. So my payoff, the payoff for my option also only has two scenarios, right? And these, the 2, 5, are the two scenarios, scenario 1 and scenario 2. Right? And you look at these two, the remaining two items. Okay? The sum of these two items is actually 1. Okay? The sum of these two items is equals to 1. And remember, last week we also say ERT is between U and D, right? Right, by no must between these U and D, so it's no arbitrage. Right, we proved that last week. So it means not only the sum of these two items are 1, but also both are positive. Right? So you have two terms. Both are positive, the sum is 1. So if we define the two items as QU and QD, they are probabilities. They are probabilities. Not real world probabilities, but they are probabilities. Okay? So we say the probability measure with respect to such a probability, we define this as Q, as the probability measure, right? Such that the go up probability is QU and go down probability is QD, right? And remember, this is not the real world probability, but only relates to the risk-free rate, okay? So this probability relates to three items, the U, the D, and the R, right? The interest rate, up and U and D, how up and down you can go, okay? All right. Okay, next. So if we assume the market is arbitrage free, the derivative at time t at the beginning can be written in this form. Okay? Can be written in this form. So this is the expectation under the probability measure Q, which we defined just now. Right? The expectation under this probability measure, the expectation of the payoff of the option. Okay? So this is the payoff, expected payoff of my option under this measure Q. And once we know the expected payoff, we discount it back to today. So that's the discounting factor. We discount it back to today. Okay? So that's my price for my derivative or my option. Okay? So which means we do not need the real world probabilities. Okay? We do not need these probabilities to price an option. And we only need Q. Okay? And later we'll so this probability Q is called risk-neutral probability. Okay? It's called the risk-neutral probability. All right. So under the risk-neutral probability measure, the price of an option is the discounted of its expected payoff. Okay? And in the binomial model, it is unique, right? Because you have a system of linear equations, two variables, two unknowns. You can always find a unique solution, so it is unique. Okay? If you look at the last point, the price can be decomposed into first one, discounting. Okay? You discount from maturity to the day. The second term is the expectation. Okay? I need to take an expectation because I got two scenarios, right? It's like an average. And then the payoff. Okay? The last one is the risk-neutral probability measure. And this applies not only to call options, but to any derivatives under the binomial model. All right. Any questions? Okay, if you go back to the quotes from the Black-Scholes, they say, if options are correctly priced in the market, it should not be possible to make sure profits by creating portfolios of long and short positions in options and their underlying stocks. Okay? And using this principle, a theoretical valuation formula for options is derived. Okay? So, in the binomial model, we show how we derive the option price by a no arbitrage principle. All right. And always remember, we have two probability measures here. One is the real-world probability measure P, and the other is called the risk-neutral probability, which is Q. Okay. Okay, so in the following, we will introduce two extensions of the binomial model. The first one is multi-period binomial model. Okay, so in the binomial model, we only consider 2 points in time, 0 and maturity t. And in the multi-period binomial model, we further discretize the time along the time horizon. Okay, instead of 2 points, we put into a finite time steps. Okay, from 0 all the way up to t. The setup for the money market account remains the same. Okay. And then the stock price can either go up or down at each time step. Okay. So we define as t plus 1. The price of underlying at the next time step is the price, it equals to the price of this time step times another variable xt, which xt can be either u or d. Okay, u or d. And with some probability measure pu and pd, but we know that it doesn't really matter, right? We do not need these real-world probability measures. Okay. Okay, so this is illustration. So at the beginning, my price is S. Okay, This is my t equals to 0. My price is S. Then at t equals to 1, my S can go up to US or go down to DS. Okay? So without the further two nodes on the right, we have a binomial model. But now we further discretize it. Now we have t equals to 2. If it goes up twice, then it becomes SU squared. Okay? If it go down twice, it becomes SD squared. And if it's go up and then down, or go down then up, then you got SUD. Okay? And further, you get t equals to 3. And at the end, you get 4 points. Right? You got 4 points. Are we able to solve to get an option? How do we get an option price from this binomial tree? Okay. So first, we noted one thing is that you will be able to get the payoff. Okay, phi as u cubed. Right, this is known. Right, the payoff of your option. Okay. I give you my underlying price and maturity, then you must know the payoff. Okay, then let's see a few definitions. Okay, in the binomial model, we build a replicating portfolio. And in the binomial tree or the multi-period binomial model, we will build a portfolio strategy, which means from time to time, okay, at different time points, I might adjust my portfolio a little bit, okay, and it becomes a strategy. It's not at the binomial model at the beginning, I build a portfolio and I wait until the end. But this time, at every discrete time along the multi-period binomial tree, I can adjust my portfolio a little bit, okay? So at any time in t, the value of my portfolio is always equals to the amount in the money market account and the amount in your assets, underlying assets. Okay. And we define a self-financing portfolio, self-financing portfolio, if the value at t is equals to its value at t plus 1. Okay, look at this. So from t to t plus 1, I adjust my money in the money market account. I adjust my number of shares. Right? But I assure that if I do it at time t, after the adjustment, this is done at time t, okay? This adjustment is done at time t. So after the adjustment, I got a new alpha and a new beta, which is alpha t plus 1 and beta t plus 1. And with this adjusted alpha and beta, the value of my portfolio stays the same, which means you did not inject any new capital to your portfolio. You did not, and you did not do any withdrawal. Okay, so which means at t equals to 0, you build a portfolio by putting in say $10. Okay, so second day you adjust your portfolio a little bit, but you didn't put in new money and you didn't do any withdrawal. Okay, until maturity. So this is called self-financing. All right. Recall that financial derivative is a contract. Okay, so we know it's payoff if you give me the price of the underlying at maturity. So a self-financing portfolio H, okay, this H is a portfolio strategy. So this H is set to replicate the derivative if at maturity, my portfolio always gives me the same price as the option. And last, we have another definition, it's called complete market. Okay? So when we just finished the binomial model, we talk about the market is complete because for any derivatives, right? For any derivatives, you can find alpha and beta from that system of linear equations. So that market is called complete, which means every financial derivative can be replicated. So that's the definition for complete market. And the multi-period binomial model is also complete. Okay, how do we solve the multi-period binomial model? So first, we compute the replicating portfolio by moving backwards on the binomial tree. Okay, moving backwards. So for the leaves or for the nodes, okay, someone also call it nodes of the tree at time t, right? At maturity, we know, right? We know the payoff at t, right? These are the 4 of them for illustration. And then we can look at for every node at t minus 1, which is these 3 nodes. Okay? For every node among these 3, we can find a replicating portfolio alpha and beta. Okay? Using exactly the same technique as what we do for the binomial tree model. Okay? And we do this recursively, which means, okay, let's look at this. This is how we actually do it. Okay? Let's look at these 3 nodes first. Okay, look at these 3 nodes first. We can build an alpha and beta, right? We can build an alpha and beta such that the portfolio will always give you the same payoff among these 2 scenarios, right? So by the binomial model, you will be able to get the price for this node. Right? And then if you look at this one, this tree, okay, then you will be able to get the price for the second node. Okay? This is another binomial tree model. This is the third one. Right? So you do it recursively, you will be able to find a price for these 3 nodes. And next, you look at these 3 nodes. Right? And you know the price at this node and this node. And it becomes another binomial model, right? You know the price of the 2 nodes. And you just build a portfolio, a replicating portfolio, and you find the price of this SU node. Okay? That way it means for recursively. And then you can build one for this, and finally you build one for the last tree. And you get the price of your option. All right? Do I get an example here? Oh, I have an example here. Okay, here's an example. So let's look at this example, okay? So this is a 3-period or 2-period multi-period binomial model. So we want to price this 1-year call option. Strike is 21. Okay. So the payoff is S minus 21 plus, so it's a call option. Okay. So today the initial price is 20, and we discrete every 6 months. Okay. So every 6 months is either go up by 10% or down by 10%. So 1 month later, 6 months later, it can go to either 22 or 18. Right? And in 1 year's time, so then you get 24.2, which is SU square, 16.2 SD square, and 19.8, which is SUD. All right? And for simplicity, we assume interest rate is 0. And how do we build such a replicating portfolio? All right, so as said, first we look at these 3 points. Okay, we want to build a portfolio such that alpha, because we look at node B, so let's denote as B. Okay, alpha B, because there is no interest rate, so we don't have the ERT here. Okay, so your money market account is always constant. Alpha B, beta B times, if it goes up to 24.2, what's your payoff of your option here? Is 24.2 minus 21, right? That's your payoff for your option. If more precisely, this is your payoff, right? So we'll just write the answer, which is 3.2. Right? And same if it goes down. If it's 19.8, then the option is worthless, right? It's below strike. 21, right? Then you get 0. Right, clear? All right. So you can solve this system linear equations, you get a unique solution. This is minus 14.4. This is 8/11. Okay? So your value at B is alpha B plus beta. Your price is 22, which is 1.6. So 1.6 basically is your value at point B. Okay? And you can do the same for C, right? You can do the same for C. Alpha C plus beta C times now is 19.8. Right? So in both the the middle scenario and the bottom scenario, the payoff option is both 0. Okay? So in this case, you get alpha C equals 0 and beta C equals 0. Right? So your value for C is 0. Right? So this is 0. This is 1.6. Okay? And you look at the final three nodes, which is A, B, and C, okay? Now, we look at alpha A plus beta A times, if it goes up to 22, it gives me 1.6. Alpha A plus beta A, if it go down to 18, then it gives me 0. Okay, so if you solve the system equation, Okay, you get alpha and beta A, alpha A and beta A. So your portfolio, your initial value of the replicating portfolio is alpha A plus beta A times 20. This is 0.8. So 0.8 is your value of your call option. Okay? See, you look at this trade first, and then you look at this trade CEF. Okay? You look at BDE, you get a value for B. You look at CEF, you get value for C. And once you know the value B and C, you can look at A, B, C and get a value for A. So this is why it's called resolve it recursively. Right? First, we know all the price and maturity T. And next step, we need to calculate the value for every nodes at T minus 1. Right? And once we know the value of T minus 1, we calculate every node at T minus 2 and all the way until beginning. Okay? So that's how we calculate a multi-period binomial model. All right, any questions? So let's consider a call option. Okay, a call option. A two-period model. We know it's payoff for the two scenarios. Okay, and then we use what we do for this example, but instead we assume everything are just variables, right? We write everything in variables, not real numbers. We can calculate CU and CD. Okay, the price and C and price and D. And then we further from these 3 points. Once we get the value for CU and CD, we can get the option of, we can get the price of the option today, which is the value at C. Okay. So after this lecture, when you go back, you should try to solve this system linear equations and see whether you can get the same solution. Okay? So this is very simple system of linear equations, but tedious. Okay? So from this, we want to see whether we can get some patterns. Okay? So the theorem is the price of the derivatives. You can write, first we discount, and then this is a perturbation, and then the QU and QD, which is the risk neutral probabilities, and then the payoff. But simply, it's just the discounted expected payoff of your derivative under the risk neutral probabilities, risk neutral probability measures. Okay. All right. So this is a discount, and this is the probability. Sorry, I should not write P. I should write Q. This is the probability, and this is the phi st. Right. So remember, your expectation is equals to expectation of x is sum of x times px. Right. So that's why that long equation is just you can just write a discounted expectation. Okay. So this multi-period model, binomial model, is also called the CRR model. Okay. So in the CRR model, we assume U is e to the power of sigma square of t, and D is e to the power negative sigma square of t. So for those who do not know, sigma is called the volatility. Okay, sigma is the volatility. And later, when we touch the Black-Scholes model, you will then after you have learned a little bit of Black-Scholes model, and you come back to look at this CRR model or binomial trade model, you will see it's actually approximation in discrete time. Okay? So we will not go to much details before we touch the Black-Scholes model. Okay? Maybe at lecture 6, if we still got time, we can come back to this. Okay? To show you how this multi-period binomial model and the Black-Scholes model, how they are actually connected. All right. Okay. The last discrete model is the trinomial model. Okay. Remember, we see the binomial model is complete. The multi-period binomial model is complete. So we want to show you one that is not complete. Okay. So this trinomial model is very similar to the binomial model, but we have 3 possible scenarios. Okay. Instead of going up to U and going down to D, there is one additional scenario that the price will stay the same. Okay. We still assume ERT is in between of U and D. Okay, so there is no arbitrage. All right? And these probabilities add up to 1. Then how do we price this option? Can we do what we did for the binomial model? We built, let's look at this example, okay? Let's look at this example. Can we build a similar replicating portfolio such that the payoff of your portfolio is always the same as your option? Okay. So in this case, we still assume a 0 interest rate, and U is 1.1. Okay, so this is S. D is 0.9. Okay, so these are the 3 possible outcome of your underlying asset. And today your S is 100. So actually, it's just, okay, 110, 100, and 90. All right, this is your S. And then my underlying option is a call option, ATM call option with strike 100. So my payoff, this is 10. Okay. Maybe it's just don't skip so many things. It's 110 minus 100 plus, and this is 10. Okay. So here is 100 minus 100. This is 0. 90 minus 100. This is also 0. Okay. So unless the underlying price goes up, I got $10 profit. Otherwise, the option is worthless. Okay. So can we build up a portfolio consisting of money market accounts and underlying assets that satisfy this equation in all the 3 scenarios? So we build a system of linear equations with two variables, but with two unknowns, but three equations. So this time, there is no solution, right? Which means we are unable to find a portfolio, a replicating portfolio, that gives you exactly the same payoff as the option, right? So we prove that the trinomial model is incomplete. Remember, what is the definition of a complete market? A complete market is that for any derivative, you can build a replicating portfolio, right? But now you have one derivative that you cannot build a replicating portfolio, so this model is incomplete. So even though this model is incomplete, can we have anything about the price? Okay, let's see these two definitions. So a portfolio H is said to be super replicate of the derivative if at maturity my portfolio always was more than my derivative. And if this is the case, by no arbitrage principle, what do I know? I know at T0, right? I know that my portfolio, the value of my portfolio must worth more than the option today, right? If at maturity my portfolio is was more than the derivative, it means the same for today, okay? And this is by no arbitrage principle. And then on the opposite, the sub-replicate means my portfolio was less than the derivatives. Then, which means at the beginning, my portfolio also was less than the derivative, okay? So this means, suppose this is my VH1, okay? This is my VH2. Then I get my VH1 is greater than the price of a derivative. And my VH2 is less than the value of my derivative. And these two portfolio gives me my upper bound and my lower bound for the price of my portfolio. Oh, sorry, for the price of my derivative. All right? So this means under the trinomial tree model, although I do not have an exact value for my derivative, but I can find the upper bound and a lower bound. Okay? Okay, so recall, let's see. We have these three dots representing the payoff of my derivative under the three scenarios, okay? When my underlying price is 90, I get 0. When my underlying price is 100, I get 0. And when my underlying price, when my underlying price is 110, I get $10, right? So this is $10. So this is the payoff of my option under these three scenarios. And then this black line gives me my cheapest super replicating portfolio. Okay? It's called cheapest super replicating portfolio. Okay. It means, what does this mean? It means, okay, if you see, I have 3 points in the payoff, right? And then this black line puts all the points below. I don't have any points above the black line, right? All these 3 points are below the black line. Okay? So that's why it's the cheapest. That's why it's a super replicating portfolio. Okay? Because my portfolio always gives me better payoff than the option, right? So either it's 90, it's the same. If it's 95, my portfolio gives me better payoff. 100 gives me better. 105 gives me better. 110 gives me better, right? So within the range 90 to 100, this black portfolio always gives you a better payoff. Okay? So then, on the other side, this red line, is the most expensive sub-portfolio, sub-replicating portfolio. Okay? All right. So again, if you look at it, within 90 to 110, the option always gives better payoff than the portfolio, right? This gives me 0, this gives minus 10, right? This both give me 0, this both gives me 10, right? So my option always gives me better payoff than the portfolio. Okay? So by this way, we actually found a lower bound and an upper bound for the option. So the price of this black line is, right, is 2 points. You actually construct using 2 points. So it's actually a binomial model. If you only consider 2 outcomes, then you can build a portfolio, right, H. And then you get an option price 5. And if you only consider 100 and 110, then you build another portfolio which gives you 0. Okay? In this case, any price between 0 and 5 is a no arbitrage price. So it means there isn't a fixed price. So any price between 0 and 5 is a no arbitrage price. And we can get the same results if we use risk-neutral probabilities. And in the binomial model, we show that the risk-neutral probabilities are unique, defined by U, D, and R, right? I think I write this somewhere. Here, right? So the risk-neutral probabilities are defined by U, D, and R. So then, but in the trinomial model, the risk-neutral probabilities is not unique, but infinitely many. Okay? So here we give an example. So for any Q in the range of 0 and 1, we define the risk-neutral probability for 90 and 100, the up and down, to be the same, to be 1 minus Q divided by half. Right? And then the probability for 100 is Q. Right? you can verify the sum is 1. And this is a risk neutral measure. Okay? And for any of these risk neutral measures, we say this is a no arbitrage price. So that is bounded by 0 and 5. All right? Okay? So that's all for the discrete models so far. We have learned the binomial model, then the multi-period binomial model. Both the models are complete. And then we learn the trinomial model, which is incomplete. And you are unable to find a unique solution for your option price. But you can find an upper bound and a lower bound. Okay? So, any questions so far? No? Okay. So before we go into the continuous time space, let's look at the last topic, got put-call parity. So in all of our previous examples, we use call options, right? We all use call options. But if you want to price a put option, for example, in a binomial model, it's actually very similar to call option, right? Because you also know the payoff at maturity. So you need a model. But if we know the price of this call option, then we know something, because look at this. This is the payoff of a call option. And this is a payoff of a put option. All right? My ST minus K plus minus K minus. So a call option minus a put option. And then you have only two scenarios, right? Either your ST is bigger, or your ST is smaller. Then your strike. So in the first scenario, your ST is greater than K. Then you get a payoff from your call option. Right? You got payoff from your call option. But your put option is worthless. Right? And if your ST is smaller, then your call option is worthless, but you get a payoff from your put option. Right? And this is, you rewrite the second one. This is actually just ST. Right? So which means, if you buy one call option and you sell one put option with the same strike, and then you always get the same payoff. Right? We are not talking about any model yet. We are only looking at the payoff. Okay? You have one call option, and you sell one put option, and you always get the same payoff, ST minus K, right? Okay, let's consider a portfolio, okay? This portfolio consists of one call option, and then I short one stock, and I put K times e to the power of minus RT in my money market account. Okay? So I denote C as the price of my call option. So at the beginning, the value of my portfolio is this call option This is the stock I short, and this is the money in my money market account. And then at maturity, this is the payoff of my call option. And then this is the payoff of my underlying stock. And then this is my amount in my money market account. Okay. And you realize the payoff of this portfolio is equals to a put option. Right? Again, you only have two scenarios, right? Either your ST is bigger or your ST is smaller. If your ST is bigger, on your left, you have ST minus K minus ST plus K, which is 0. Right? And that is, right? So both sides equal to 0. If ST is smaller, then your call option is worthless. On the left, it becomes K minus ST, right? And then on the right, your put option is exercised. You also get K minus ST. So your portfolio always gives you the same payoff as this put option, right? So this is today. If I denote the price of my put option as P, then today my put option price is equals to the price of my portfolio. And what's in my portfolio? A call option, one short of the underlying asset, and this amount in my money market account. Okay. So this is called the put call parity. And we are not talking about any model. Which means for any model, this put call parity should be fulfilled. Okay? And this is actually a very common test you need to do when you want to develop any models. Okay? So I develop a local vol model. I want to price and use it to price options. So better to price, you do test it, price some put and call options. Make sure it fulfills the put call parity. That's the baseline test. All right. Questions? Okay, if no questions, then that's all for the discrete models. Let's take a break and come back at 8:20, and then we'll continue the continuous model. So for any measure Q, if you can find this one, that is between 0 and 5, then it's a risk neutral measure.
So it's like, it's just a range?
Yeah, it will become a ring. Yeah, you won't have a unique solution.
Oh. So is this Q the same thing as Q before?
That Q is unique.
Oh, that Q is unique.
The Q under binomial model is unique.
Yeah. So what is this? Is like the probability?
Yeah, it's a probability.
Oh, it's a probability. So it's just like you need signals for the like model for these models. It's just like a sign.
Yeah, you basically you artificially assign it.
Oh, just a sign. It's not like.
But for this one, it's unique.
For
For
this
binomial,
one,
it's unique.
and here it is the same Q.
Yeah, that's the same Q.
That's
the same Q.
So it's just a simple expectation.
Yeah,
Just like
under this,
we have
yeah.
probability.
You define a probability. Under this probability, you get an expectation.
So we define it.
In a way, yes. Yes. But what essence you have?
replicate the Jordan.
So because this is binomial model, it's relatively easy. You can do a replication every time, right? Find the alpha, beta, and Q. But this is universal. So later when we talk about the Black-Scholes model, we will also have a risk neutral measure. So under that model, you can just every time I try to find a replication portfolio value. Instead, you can always practice replication.
But like in this case, like we only prove this the correctness of this formula for the binomial case.
Yeah. But no, this is okay. This theorem says that as long as you have a risk neutral probability measure, then this one also always holds. The problem is how do you find this neutral measure?
So why do we see this why do we see this measure?
Oh, we just call it risk neutral.
For this okay. So in what sense is this risk neutral?
Later if you look at Black-Scholes model, the risk neutral measure says if the underlying stock price go with the expected return of the underlying stock is always the risk-free rate. So it's the same as risk-free rate, no risk. So it's risk neutral.
So like in this case we just define this is called risk neutral. And we find the risk neutral and this proof is only applicable, is only valid for the
You didn't prove anything. You don't prove anything. You didn't prove anything.
If we prove this formula
We just show you this. You can solve the equation and write it this way. And we define these two as risk neutral probability.
so like for binomial model this is risk neutral probability.
Yeah.
But for other models this is not.
Other models they have their own. Like if Black-Scholes model is continuous, the measure will be also in continuous time.
And this model is different. How do we exactly, for example, like at time, so we didn't take out or take in any money during this previous trip time intervals. So I think how do you actually make the transaction? And do we need to like for example like we need to sell out some of our like stocks
Oh, it's because like this is 1.6. This is value of your portfolio. Right? And when you do this one, you assume this is 1.6. So here this is 1.6. Here this is 1.6. So it's from here to here, the value doesn't change.
And then so we came out with our own portfolio. It's like alpha T.
Yeah, we calculate our own alpha t, all the alpha beta we calculate.
This is just in theory. Right? Like, what if, for example, I really have a portfolio using at time t, bt, alpha t and beta t, and the next time, for example, like a day later, or like a week later, at time t plus 1, I can make the portfolio like this without taking out of any money. Is it doable in reality?
Yeah, of course. You just take money, take out from your alpha to buy the assets. You see this side is alpha t beta, alpha t s here. This is t plus 1, but s is also t. So basically means you either take it out to buy the stock or sell stock.
Okay.
That's all you do.
Regarding to so this is commutation.
Yeah.
It's not combination.
You choose k from t.
It's not combination.
You just choose k from t.
And then we treat this wise commutation and then computation. Recognize why we see this is the cheapest.
Because you need to ensure these three dots are below the black line. And if you either way above this black line, along this region, along from the region under target, your pen is more expensive.
Why is that we will for example
super replicating portfolio. But this portfolio was always more than the black one, so it's more expensive
Also, like this portfolio is always more expensive. So
than the black one, than the black tree. So if I want to draw a line, make sure all the three dots are above the black ones. So either I draw this one, or this one. It's all like it's always more cheaper.
so you like by saying like this one is the price of each. This one is the price of a stock at MT. This one.
Yeah, that's why it's priced at 10p.
So like if I see like this portfolio is more expensive, like you are seeing that like for example like if the S1 is 100, for example like you just draw this line. So if the S1 is 110 and S1 the payoff of this line is greater than this, so we see it's more expensive. But what if I draw this line? I draw this one. It's more expensive or cheaper.
If you look at, then in this case, the 90 points is more expensive than it's more expensive. Sorry, if you look at 90, this one is cheaper than both, right?
Yes.
And if you look at 100, then it's cheaper. It's still cheaper, but if you look at this point, it's more expensive. So in this case, it's not a super replicating. It's neither a super replicating nor a sub-replicating.
Yes, it's not a super replicating. So not sub-replicating. So we cannot say it's cheaper or more expensive. So like cheaper and expensive, I see more cheaper or more expensive. We're only referring to the super replicating, sub-replicating.
Yeah.
So for super replicating portfolio, no matter what the value of this one is, so it should always be have a greater payoff than our portfolio. So like you can see it's cheaper or more expensive. Like for example, like if I draw this one, it's also super replicating.
Yep.
But and all the values 90, 100, 110, this has greater payoff. So it's
It was more than the black one, so it's more expensive than the black one.
I think more expensive we are seeing the rewards of the portfolio at 10T.
At zero. Right? So basically, suppose this one you draw here. Suppose this is your H star, and black one is your H1. So your H star at time t is always greater than your H1 at time t. So your H star at 0 is also greater than
So because of no arbitrage.
yeah. Right? So it's more expensive. At the beginning, you need to invest more money, so it's more expensive.
Okay. During the cost combination, for example, this one and this value,
They're actually irrelevant. Not really relevant.
They cannot take on this value. Only take these three values.
Okay, let's get started. I got a lot of questions about this graph, so maybe I think I'll just explain a little bit more. Okay. So for this option, okay, let's go back to this trinomial model, this payoff chart. Okay. So this option has three possible payoffs: 90, 10, and 110. Okay. Now, in order to find a super replicating portfolio, I want to find one that always gives me better payoff than the option, right? So, which means that line should cross somewhere here, right? So it gives me better payoff at this point. It should be cross somewhere here. It also cross somewhere here, right? So it gives me better payoff. And if I draw, suppose I draw this line, is this a super replicating portfolio? It is, right? Because all the 3 points, this portfolio, let's denote it as H star, it always gives me better payoff than the option. But if you look at, consider this black line, let's denote as HB, right? Black. You will find at maturity, my H star is always bigger than my HB, right? The value of my H star portfolio always was more than the value of my HB portfolio. So which means by no arbitrage principle at the beginning, my H star portfolio need more investment, right? So it's more expensive, which means for any portfolio, right, you draw like this, it will be more expensive. So that's why the black line is got the cheapest, okay? Because any line you draw such that it's above the 3 points, it's more expensive. You can derive it from this way. And it's similar argument for the right line. Okay, it's similar argument for the right line. Okay. Okay. So we have C binomial, multi-period binomial, trinomial, and these are all discrete time, right? Binomial and trinomial is we consider 2 points, 0 and maturity t. And multi-period binomial, we discretize the length of the option into a few partitions. Okay, we put it in a partition. And we now want to move into the continuous time. In which case, if you look at a multi-period binomial, basically we put t into n periods. And if n goes to infinity, right, then for every 2 points we consider, the duration goes to 0. Okay? And there are some examples, right? If we put into 5 time points, that's the first graph, and it goes to 10, goes to 50, still looks like discrete. But if we put into 10,000, then it starts to look like a little bit continuous. Right? And these examples are actually simulation from a multi-period binomial model. Okay, so today we will mostly look at some examples and some review of some statistics and probabilities which you are supposed to know before this course. Okay, let's look at some definitions. First, a stochastic process is a family of random variables, xt. Okay? So, and T belongs to some set. And this set either be Z or R. If it's Z, 1, 2, 3, 4, okay, then this is discrete time. And if it's R, then it's a continuous time. Okay? If it's Z, then it's discrete time. Otherwise, it's continuous time. And each time t, xt is a random variable. It is a random variable. Okay? And for each sigma, then the xt sigma is a function of t. And this is called a sample pass. This is called a sample pass. And if you learn Monte Carlo simulation, so I want to simulate my underlying stock, how it moves along time, right? So your first simulation may be like this, second simulation like this, third simulation may be like this, and each one is called a sample pass, right? This is your S, right? When you do a Monte Carlo simulation, you simulate how your underlying stock may move, right? You may simulate 10,000 paths, and each one is called sample pass. Okay? And if it's discrete, then this xt is a discrete time process. Continuous time process, okay? But our focus will be on the continuous time process. Okay? So xt is just a random variable. It's nothing but a random variable. And we'll use the notation xt. Either xt, we put a subscription, or we put a bracket. They are the same, okay? They are exactly the same. It's just different habit of using the notation. And why we want to consider this continuous time stochastic process is because sometimes you can get a closed form formula. For example, the Black-Scholes model, right? We all know the famous Black-Scholes formula, and that is derived from the underlying assumption that your underlying stock follows a continuous time process. Okay? Okay, so this is a recap of some probabilities expectations. Okay? So if you have a random variable y with finite, first order, okay? Define our probability space, sigma, f, and p. And then you have a subfield, sub-sigma field, G. And then when we define a conditional expectation, okay? This conditional expectation, the expectation of y conditional on sub-sigma field G, then this itself is a random variable, right? It itself is a random variable, and it is G measurable. It is G measurable. Okay? And second, if you look at the expectation of y given G, and you take an expectation again, this is more similar to the tower rule. This is often actually we write as expectation of expectation. So y given G, right? This is expectation of y. Okay? If we get rid of the z, and this is actually what it says. Okay? This is the tower rule. We get rid of the z. Okay? And this expectation given G can be considered like an operator. And it has these 7 properties. Okay. First one, if y is non-active, then the random variable y is non-active. Then this random variable, expectation of y condition on G, is also non-active. Okay? It's like G is like I give you a little bit more information about y. Right? G, you can consider G is like I give you a little bit more information about y. Okay? And this operator is linear. Right? Basically consider as a random variable. Okay, you can take the coefficients out and break the plus. And is a projection, right? As I said, G is like I give you a little bit more information. But I give you the same information twice, it's the same I give you the information once, right? The second time is a bit useless. Okay, so this is the projection rule. Right? The expectation of y given G has already considered the information you give me in G. And you give me one more time of G, it doesn't help. Okay? And if y is independent of G, the first one, if y is independent of G, means G has no information about y. You tell me something that has nothing to do with y, then it's useless, right? It's not helpful. Right? It doesn't change anything, it's not helpful. And then if H is a subset of G, okay, so this is the power property. If H is a subset of G, right, which means you give me some information about G, you give me some information in G, okay, sorry. G has some information about Y, and H has more information, right? So which means you give me H is good enough, right? You give me H is good enough. Right? So you will always end up here, expectation of Y given H, because H has the most information. Right? And this is the property we mentioned in previous slides. Right? You take 2 expectations, you end up with expectation of Y. And the last one, the expectation of xy given G. But y is G measurable, which means the information in G does not give you any additional information about y. Right? So basically you can take your y out. Okay? So these are some fundamentals in your probabilities, expectations. Okay, so this is an illustration, okay? Suppose we have a random variable defined on 0 and 1. And then the red one is without any information, I know my distribution of the random variable follow the shape in red color. And then further, B says I got a little bit information in this 4 field, okay? Then if condition on B, then expectation of X condition on B, right? It means from 0 to 1/4, I know I told you B, right? So it's within 0 and 1/4, so my expectation is a constant, right? Then it becomes a variable within this 4 subset. Okay, So this tells you the expectation given B and C give you some additional information, but it's still a random variable. Okay. Okay, filtration. So let's consider a continuous time process xs, and then the filtration is the information about the past up to s, up to time s. Oh, sorry, up to time t is ft. If up to time s, then it's fs. Okay? So that is the filtration. Okay, so it's called the filtration generated by this process. So because it's generated by this process, it contains the information of this process. Okay? So basically it says ft has all the information of xt up to time t. Okay? So for this course, I think what you need to understand is ft is like an information. Okay? It's like information. Okay, Markov process. The Markov process says if given the value of the process at present time t, I know now it's t, I know my value xt, and I'm interested to know my future value. Okay? And if my future value does not depend on its past, then we say it's a Markov process. Okay? So this one, I think this property didn't say for t greater than s. For t greater than s, then my distribution of my xt. Okay, on the left equation says the probability of the distribution of my xt given all the past information up to s. Given all the past information up to time s. Then it's the same as the probability of t given only my value at time s. Right? So here is all the information up to s, from 0 all the way to s. And this is only one point s, and they are equivalent. Means from 0 any time before s, the information is useless. Okay? The information is useless. So this is called Markov property. And it applies to function of fx. Okay? If it applies to x, then it applies to function of x. All right. So let's look at an example. Suppose we have two random variables, x1, x1 tilde, and they follow uniform distribution on -1, 0, and 1. Okay? And like y1, y2 to be IID. IID means independent, identical, distributed. Basically, it says all the y's, they follow the same distribution, and they are independent. Okay? It's a common term in statistics. So the y's are not only independent from each other, but also independent of x1. Okay? And the y's are uniformly distributed on -1 and 1. Okay. We define x to be an xn and x tilde to be xn tilde. Okay. Further, we define xn plus 1 equals to xn plus yn plus 1. And xn tilde n plus 1 equals to xn tilde plus yn plus 1. Let's see. We want to show that x is it fulfills the Markov property, but x tilde is not. Okay. Let's see. For what is the probability of x tilde 3 equals to 1? Okay. If you look at this, the chain rule, okay. So the x tilde 1 can be -1, 0, or 1, right? Then x tilde 2 is x tilde 1 plus yn plus 1. And yn plus 1 can be either plus 1 or minus 1. So it can be -2 or 0 or 2. Right? And then x3 will be plus another yn plus 1. Okay? So then it goes left and right and left and right. Okay? Okay. But the difference is if you look at this, the probability of x3 tilde equals to 1, given x2 equals 0 and x1 equals 1. So I know the past information at time t equals to 1 and time t equals to 2. And if you look at this, then the chart, x1 equals to 1 is here, right? Then x2 equals to 0 is here. Then what is the probability that x3 equals to 1? What is the probability here? It's 1/2. Okay? It's 1/2. It's either plus 1 or minus 1. Right? So this is 1/2. And this is, what is this? This is F2. Right? All the past information up to t equals to 2. Okay, now what is then what we see what is the probability x3 tilde equals to 1 if I only know the information at t equals to 2. That is x2 equals 0. Right? If x2 equals 0, then it can be x1 equals to then it becomes a summation, okay? A summation. This is conditional probability, right? This is conditional probability because we have 3 possible scenarios for x1 tilde. Okay? So x1 could actually be -1, 0, or 1. Okay? And this one, look at this one. If x2 is 0, can your x1 be 0? If x2 is 0, can your x1 be 0? Your x2 is equals to your x1 plus yn plus 1. And yn plus 1 can only be -1 or +1, right? So if your x1, if your x2 is 0, then your x1 cannot be 0. Okay? So the second conditional probability says if your x2 is 0, your x1 can only be -1 or +1. Okay? The probability of each is 1/2. Okay? Each is a half probability. And that's why you have a different result. Okay? If I know all the past information, I got 1/2. But if I only know x2, then I got 1/4. So that's why this is not a the x tilde is not a Markovian. So many models used in finance are Markovian, okay? Because they are analytical tractable. That's the mathematical advantages. Okay, so we always assume the stock price follow a Markov price, and it's intuitive. It says the future evolution of the stock price means tomorrow how my stock price gonna move depends on my price today, or depends on my price now, but not my price yesterday. Okay. So I say it's intuitive because, excuse me, all the information of the past price, okay, is embedded in today's price. Okay, it's embedded price. If I know the past, that gives me a different outcome of my estimation of the future, then everybody will react. Right? So the price now reflects the people's reaction. So whatever happened past, people have already reacted, and the price has reached an equilibrium. Okay? So this is called market efficiency. We always assume the market is efficient. Okay? We always assume the market is efficient. Okay, next, the martingale. So what is a martingale? A stochastic process xt is called a martingale if for a t that is greater than s. Okay? Then my expectation of xt, you can see as my expectation of the future price of my stock. Okay? This can be see like what's your expectation of the future of your underlying stock. Given my today's price, suppose today is S, and all the past, okay? All the past price is equals to my today's price. It means I know everything what happened in the past. My stock is trading at $50 now. And I expect tomorrow, my expectation for the stock price tomorrow is 50. 1 year's time is 50, is also 50. Okay? So for any t that's greater than s, my expectation stays the same as my today's price, given the history information. And this is called a martingale. Right? So intuitively, the martingale process, your underlying will move along today's price, right? If you do a simulation, this is my today's price, and then you do a simulation, it will move around your today's price. And then if this expectation goes up, then it's called a super martingale. Oh, sorry, if it increases, it's sub martingale. And if it decreases, it's called a super martingale. Okay? And this is an illustration. So if you look at the middle one, is a martingale, right? At the beginning, my stock price is $10, right? So I simulate for many paths, then at maturity, or in 1 year's time, on average, my stock price is also about $10. So this is a martingale. And then for a super martingale, the average in 1 year's time is actually smaller than 10. And then for a sub-martingale, the average is greater than 10. Okay? All right? Okay. So this is an example of a martingale. Suppose z is a random variable. Then we define xt to be expectation of z given the filtration ft. All right? Then if we look, then xt is a martingale. Okay? xt is a martingale. And the proof is very simple, right? We want to prove the expectation of xt given fs. Right? And then where is xt? xt is expectation of z given ft. And for ft and fs, only fs works. Right? And then by definition, this is xs. Okay? This is the Tower rule. So this is an example of the martingale. All right? Okay, next we want to introduce a definition called stopping time. A stopping time is a random time tau with respect to some filtration ft. And it says, and the event tau is the event tau smaller or equal to the t belongs to ft. What it says? It says, if I have the information up to time t, that is ft, then I know my tau is smaller than t or not. Okay, it's like a binary check. Okay, I know my information up to t. Then I know whether I have stopped or not stopped. Okay? So this is a decision to stop at time t depends only on the history of the process up to time t. Okay? So the example is an American option. So what is an American option? Recall a European option, which is, we always use an example in the discrete model examples, right? So at maturity, a call option gives you as t minus k, and for call options, and k minus xt for put options, okay? This is a European option. For American options, is you can exercise the option anytime between 0 and t. So the payoff is as tau minus k for call options, and k minus s tau for put options, for tau greater than 0, smaller than t. Okay? So for American options, you can choose when to exercise your option or when to stop, take an action. So this is the application of the stopping time, or sometimes we call it the optimum stopping time. when is the best time to exercise your American options. Okay, so in the market, there is another option that is often related to the optimal stopping time is called time option. So what is a time option? Remember last week we learned what is a forward. Remember what is a forward? A forward is a contract signed today where the buyer and seller agrees to buy or sell the underlying asset at maturity. Right? For example, you sign a forward that agrees to buy 100 shares of Google stock in 1 year's time at $100 per share. Okay, that's a forward. So time option is similar to a forward, but slightly different. Suppose it's, okay, let's look. This is starting, this is 1 year's time, okay? So forward, you exchange the money and the underlying asset at 1 year's time, okay? But a time option says suppose this is 11 months. And the buyer of time option can choose to exercise this forward, which means the buyer choose when we exchange the stock and the money between the last months. Okay? In the last month, you can choose when to exercise. But if you don't, then at maturity 1 year, you're going to exchange, right? So basically, you have an option to early exercise, to early exchange this forward. Okay? And this is often used by corporates that they have a future foreign exposure, foreign exchange exposure, right? I know I need some Japanese yen in 1 year's time, but not exactly 1 year's time, maybe 11 months, maybe 1 year's time, roughly around that time, but I don't have an exact time. Then you can use a time option to manage your risk. Okay? So this is the stopping time. So let's come back to the American option, right? So the American call option entitles the buyer or the holder a payoff as tau minus k, right? And tau can be chosen by the holder or the buyer. Okay? You can exercise this anytime between 0 and t. And why this is related to the stopping time is because the holder decides to exercise the option at the time tau before t. This decision can only made by analyzing the market information up to time t tau. Okay? Today, I want to exercise my American option. I want to consider, should I exercise my American option today? The only thing I can do is analyzing the information up to now, okay, the history. I cannot analyze the information tomorrow, right? So cannot use the market information from the future beyond time tau, okay? Right, so this is the American options and the optimal the stopping time, okay? Optional sampling theorem. This is another thing, another definition we have. So it says for martingale xt, right? We know xt is a martingale, and we have a stopping time tau. Under suitable conditions, okay? we say the expectation of x tau is equals to the expectation of its, some martingale. Often we know the beginning or the initial value. So we say the expectation of its x tau is just the initial value. Okay? But it says under suitable conditions. Okay? Let's look at an example. So xn equals to the summation of yi's. Okay? And yi is uniformly distributed on -1 and +1. Uniformly, okay? Half-half. So the probability is half and half. So your expectation of your xn is 0. Right? Your expectation of xn is 0. So your expectation of xn1 given, say, n2, then its expectation of xn1 given xn2. Okay, so this is a martingale. This is a martingale. And then let this stopping time tau to be the minimum of t such that xn equals to 1. Okay, it's the minimum of t, xn equals to 1. Then we know x tau equals to 1, right? Because tau is the minimum of t such that xn equals to 1. So x tau equals to 1, right? So x tau is not a random variable then. Itself is a fixed number, it's 1. So expectation is 1. Right? But your expectation of your initial value is 0. Right? So this is not a martingale. Okay? This is not a martingale. Because I artificially design a tau such that when I stop, I know exactly what is my x. Okay? And in this case, there is possibility that your n is actually infinity, right? Think about that. Is it possible that n is actually infinite? In the worst case scenario, means you draw a y, it's -1. You draw another y, it's -1. You draw another xy, it's -1. So it's like the gambling theory, right? Their theory, if you're rich enough, you can go to a casino, you put $1. If you win, you put another $1. If you lose, you put $2. You lose, you put 4. Right? So this is something similar. Okay? Any questions? You all prefer to ask the question after class. That's fine. Okay. Okay, then we have summary for today. Okay. So today we finished the discrete models, the multi-period binomial model, the trinomial model. So this is just to give you some flavor of the financial models, okay? And then we look at the called parity, which is model independent. So you will see it from time to time. When we learn the Black-Scholes model, you will see it, okay? And then we have some definitions, and in the continuous time stochastic process. We have some review of the fundamental probabilities, okay, expectations, okay? So this, we will use these fundamentals, okay, in the next lecture. So from next week onwards, we will start to see some challenging proofs, models, okay? Then that's all for today. Okay, if I have no other questions, have a good night.
Release the tutorials or like any practice questions for, because I think last lesson you said you released some practice questions.
I did for lecture 1, right? I think so. I think I did. Let me check. Wait. Oh, I didn't. Okay, I'll upload tonight.
Okay, thank you.
Okay, thanks. Hi.